Today we have attractive subject about profitability analysis. As you know, we can divide ratios into 5 categories: activity ratios or turnover ratios, liquidity ratios, solvency ratios, and profitability ratios. Valuation ratios. In this lecture, we talk only about profitability analysis. First of all, we need to define what do we mean by profitability analysis. In simple, we can define it as evaluate the company's ability to generate profit. So, if you need to compute or assess the company's ability to generate profit, use profitability analysis. Now, generate profit from what? From sales. We need to compute profit margin ratios or margin ratios. If from assets, we need to compute return on assets. If from owner's equity, we need to compute return on common equity. So, in this slide in details, we talk about generate profit from sales. These ratios measures the company's ability to generate profit from its sales. So we have 3 major ratios for margin ratios. The first one, gross profit margin ratio. The second one is earning before interest and tax or operating income margin ratio. The third ratio is net income margin ratio. How do we compute them? In the next slide, this slide, we explain how we can compute gross profit margin ratio. The gross profit over net sales. Earnings before interest margin ratio, also earnings for interest and tax over net sales. The third ratio, net income margin ratio, net income plus I, interest rate, multiplied by 1 minus tax rate over net sales. We add interest rate because we need to ignore and exclude the finance effect on net income. So we go to the next ability of the company to generate profit from, not from sales but from its assets. We call it return on assets. Return on assets, we compute return on assets by divide net income over average assets. But net income, here we should add interest expense multiplied by I, multiplied by 1 minus tax rate. So we exclude the finance effect here also. Now we need to decompose or to compose and analyze the components of return on assets. We can compute it by divide it into 2 ratios: profit margin ratio, net income over sales, multiplied by sales over average assets or assets turnover. So if we want to enhance our return on assets, we have 2 major strategies: by enhancing our profit margin or the company's ability to generate profits from its sales, or by generate the company's ability to generate sales from its assets. So get profit more from $1 of your sales or sell more. This is the 2 strategies. You can use them to enhance your return on assets. Then we go to the return on common equity. Return on common equity, as you see, my student, net income minus preferred dividends, if we have preferred shares, over average common equity. And here I only talk about average common equity. What do you mean by common equity? If we have any preferred shares and their rights, you should exclude them from owner's equity to compute return on common equity. We can also decompose return on assets into 3 ratios, sub-ratios: profit margin ratio, net income over sales or revenues, multiplied by assets turnover, total assets turnover sales over average assets multiplied by average assets over average equity or leverage. So if we ignore interest and interest rate expense effect, we can combine between return on assets and return on common equity by using return on common equity equal return on assets multiplied by leverage. What do you mean by leverage? Average assets over average equity. My student, in this slide, you need to compute the following schedule. To compute return on assets, return on common equity, and the sub-ratios of them, and then how can we calculate them in the next lecture. Thank you for listening. See you tomorrow.